Hey, everybody.
Hello.
Hey, Colin.
How's it going?
Good.
Nice. We ready to do some fun learning? Who doesn't love to talk about mortgages? There's nothing more fun in the world, I'll tell you what. Holly, are you on here but just muted with PhD meetings? Is that my thought?
Yep, I'm right here.
Awesome. Hello. Now she's got to unmute herself to say hello back.
Hi.
All right. I think we can get started here, guys. This is, I know some of you were on the condo bit last week, and I thought that was good. I mean, obviously, a lot of kind of in the weeds, very detailed information. This is going to be more of a general overview when we talk about just what I mentioned in yesterday's meeting. So yeah, I know which box to check of the purchase agreement, but if you want to learn more about specific loan types, this is a really good overview. So thanks for being with me. If you guys want to ask questions at any time, just jump in, and I'll leave some pregnant pauses in here to make sure that I'm not running over anybody on questions. Before we do start, number one rule of anything when it comes to mortgages is that there are no dumb questions. There's so much that is, I have a hard time keeping track of it, to be honest. So no dumb questions, no matter what, when we do these trainings. Let me jump in here and share my screen. All right, can you all see that beautiful stone arch bridge?
Sure can.
Awesome. Okay, so let's talk. Why the heck is it not doing it for me? There we go. All right, so when we talk about mortgage loans for residential properties, they generally will fall into three different buckets or categories. You have government insured loans. So those are loans that are backed by and insured by the U.S. government, specifically HUD, the U.S. Department of Housing and Urban Development. Those would be FHA loans, VA loans for veterans, and USDA rural development loans. Okay, so FHA, VA, USDA are all government insured, or shorthand government loans. Then you have conforming loans, which are certainly the most popular when you talk about home purchases. Those are going to be conventional loans, which I'm sure you're all familiar with. And then you also have a third bucket or category, which is non-conforming loans or jumbo loans. Those are loans that are not sold to anyone, and they're kept on the books by the lender. So for example, Wells Fargo gives somebody a jumbo loan for $1 million. They're not selling that loan. They're not underwriting it to Fannie Mae or Freddie Mac's standards. They are simply approving the loan and then keeping it on their books. So government, conventional, and jumbo. Let's talk about government loans, and let's talk about the very first type of government loans, You are talking about FHA loans. FHA loans have advantages. You've got a 3.5% down payment, FICO scores which go down to 580 at 3.5%. Now, you might ask, can you do an FHA loan for a buyer that has a credit score below 580? And the answer is yes, but that down payment goes up to 10%. Okay, so anything above 580, 3.5%. Anything below 580, still doable, but at 10% down. You've got looser DTI requirements. When I say DTI, that means debt to income. So if you're calculating debt to income, for example, let's say you have somebody that makes $60,000 a year before taxes, that's $5,000 a month, okay? You cut that number in half, that's $2,500. The general rule of thumb is that any new mortgage plus any other debt that they have, car loans, student loans, or credit cards, cannot exceed 50% of the gross income. It's really simple as that. Now, FHA, you can go above that threshold. So let's say that you have a a buyer that has a $2,000 mortgage that they want, but they've also got $1,000 worth of debt. FHA will, in some cases, go up to that 57, 58% of debt to income, whereas conventional will not go over 50. So FHA certainly is an option to expand a buyer's qualifying range. So what are some of the disadvantages of FHA loans? Number one, you have life of loan PMI. That's mortgage insurance that is going to be on that loan from payment 1 to payment 360, unless they refinance or obviously sell the property. Okay. There's a caveat to that, in that if you put 10% down on an FHA loan, that PMI will go away after 11 years. But very few people put 10% down on an FHA loan. So you've got that PMI that's like a bad disease on FHA loans. It never goes away. Okay. The other thing is that FHA will charge you not only PMI for the entirety of the loan, they will also charge you upfront MIP, as if there weren't enough acronyms in the mortgage business. That is the mortgage insurance premium. Ironic, right? That is 1.75% that they're going to hit you with upfront. So if you've ever seen a loan estimate on an FHA loan and you say, holy cow, those are really expensive closing costs, it's because FHA is collecting 1.75% of the base loan amount, which is pretty close to the purchase price, in upfront MIP. So if you think about that, let's say you're doing a $300,000 FHA loan, right? You know, that's over $5,000 that is immediately equity out of your pocket as an FHA buyer. Now, that gets financed into the new loan, so it's not like you have to come up with standard closing costs and this extra upfront MIP, but it is certainly something that, hey, I saved my butt off to come up with a 3.5% down payment, and now the government is taking half of that. It's kind of a bummer. Okay. And then, as you probably are aware, FHA loans will have more strict appraisal processing or guidelines, right? Josh, you're on this call. Josh, we found that out for sure. And you know, he worked it out because he's a good agent. But you're talking about things like chipping and peeling paint. You've got handrails that may go from the property, a bunch of things that conventional appraisers will never call, but FHA and VA appraisers will call. So that's typically something that comes in the form of a work order, where it's like, hey, yes, the appraiser says the value is there, it's worth $300,000, but you need to go out and fix these things so that it is in line with HUD's handbook and up to FHA's appraisal standards. So that's a snapshot of FHA. Any questions on that?
Colin, you mentioned a refi on an FHA. When would you recommend a refi?
All right, so it's a really good question. A refinance on an FHA loan, it depends if they are refinancing from an FHA to another FHA, which is an FHA streamline. For example, let's say you had somebody that closed at 5% on an FHA loan and rates go down to 4%. You can do a really easy FHA streamline as long as there's a benefit to the borrower. What happens more often is that you'll have somebody that gets into a property with an FHA loan. Yes, I own a house. This is fantastic. Let's say you've got FHA buyers that bought back in 2018, 2019, 2020. They have seen their home appreciate in value, and they may now have a 20% equity position. So they're like, awesome, I want to get rid of my PMI because it's going to be on there forever if I don't. They might want to refinance into a conventional loan to drop that PMI. Now, it's a little bit difficult now because we've seen rates go up so substantially, but that was certainly a huge advantage that people took advantage of in 2020, 2021 with rates being low. They said, I'm going to refinance out of my FHA loan, get a conventional loan, and drop or reduce by PMI. Does that make sense?
Yep.
Any other questions on the FHA loan? Okay. Move on to government loans, VA. All right. VA loans obviously are restricted to service members and their, in some cases, surviving spouses. So if you've served in either an active duty role or you've been in the National Guard for a certain amount of time, generally that's a 6-year requirement, you would be eligible for a VA loan. VA loans are great products. The advantages, 0% down, no PMI, right? So where FHA hits you with 3.5% down and monthly PMI, VA loans do not require monthly mortgage insurance. Similar in terms of the FICO score requirement, down to 580. You can do VA loans below 580, but they will generally have requirements similar to 10% down. It's not as hard and fast a rule as FHA, but compensating factors are required for VA buyers with FICO scores below 580. You've got those same looser DTI requirements. So VA will allow you to leverage more of your income than conventional and even FHA will in some cases. The VA loans in a lot of instances are the loan that allows you the highest buying power than any other loan out there. Drawbacks, talked about chipping and peeling paint. It's exactly the same on VA loans when it comes to appraisals as it is on FHA loans. And then there's a VA funding fee. The VA funding fee is exactly like HUD's upfront MIP. They will charge the veteran based on whether it's 0% down, 5% down, or 10% down, and then whether the vet is using the VA benefit for the first or a second time. Okay. You do have veterans that have suffered a VA related disability that are exempt from this funding fee. So it would be valuable whenever you're talking with a veteran that's interested in purchasing a home loan, make sure they engage a VA smart lender like ourselves. And number one, talk through the advantages that are outlined here. And then number two, talk through whether we or they can get a copy of their certificate of eligibility, which will spell out whether they are exempt from the funding fee or not, and also clearly states what their VA entitlement is to make sure that they can use the benefit. Questions on VA loans?
What's the max right now? Is it like 525 still?
There is no maximum on VA loans.
There isn't?
There is not.
Okay.
There is not. It's interesting in that, gosh, that's a really great question. And I was looking at that this morning because I have a buyer who's VA at $725,000. The answer is that the county loan limit will dictate what the quote max is. So if you think about the county loan limit being $647,200, Kristen,
Mhm.
right? That is technically the max VA allotment. Now, some lenders will require you to put a certain amount down after that county loan limit. And the back of the napkin math is that just because you're maxed out on that VA loan limit does not mean that you can't go above and beyond. So if you have
Right.
somebody that wants to buy an $800,000 property, they would only be responsible for 25% of the difference between that new purchase price and what the county loan limit is. So you follow my math, it's about 25% of $150,000. 800 minus 650,
Yeah.
right? The VA guarantees, it will continue to guarantee 75% of that gap, and the veteran is typically responsible for 25% of that difference. Make
Oh,
sense?
interesting. Yeah. Yeah. Okay.
It's a really good question.
Well, we personally used one, so.
Nice. Very good.
And what are the do you know what the parameters are for getting the VA fee waived, the funding fee waived?
Whether if you're exempt, you mean?
Yes.
Yeah. So it is determined by the DVA,
Okay.
where they, my understanding is that there are medical tests involved that will determine whether there's a disability that the veteran has suffered and whether that disability is tied to service.
Okay. Thanks.
One thing that is a misnomer about VA loans is that people think I've already used my VA benefit, and the reality is that you can certainly use a VA benefit more than one time.
We've used it twice.
There you go.
Yeah.
Awesome. Are you the veteran or is your husband?
My husband.
Okay. Gotcha. Well, thank him for his service. We really appreciate it.
Will do.
I was going to get this graphic in here, but I couldn't find it where there's a picture of a veteran in active, with a gun and everything. And there's a great tagline that said, "This is my down payment." So, but of course I couldn't find it, and now I have to explain it, and you got to be there anyway. All right. So next up, let's talk about the third tier of government loans, USDA rural development. All right. This is also a 0% down payment. A lot of people are not familiar with it, especially where we are in the Minneapolis-St. Paul area, because you have, very few perhaps properties that fall into this range. We have a USDA loan that closes tomorrow in New Prague. That is a 0% down loan. You will have cheap PMI as well on USDA loans, and they will also go down to 620. So not quite all the way down to 580, pardon me, like FHA and VA, but they will go down to 620. Drawbacks on USDA 0% down rural development loans. Obviously, you can only buy in a certain area. And that map is accessible to anybody and everybody. If you ever want to check a property, I had a buyer that wants to buy in Watertown yesterday, and I'm like, oh my gosh, I wonder if Watertown is in a USDA eligible area. Fun fact, it's not. But if you ever want to look at the map, that is something that I will pull up here once it pushes me through all this property eligibility thing. I'm going to put that in the chat as we speak. Come on, Colin. So if you ever want to check whether a property might be eligible for USDA, you can click on that map and it'll tell you exactly what is and is not. You have a more strict appraisal process, but these are conventional appraisals. Okay, so these are actually not a USDA specific appraisal like FHA and VA requires. It is a conventional appraisal. The only thing that is different from a standard conventional loan is that they require the appraiser to go in the attic, go in the basement, go in crawl spaces, things like that. But generally, it is not as stringent as your FHA chipping and peeling paint, VA chipping and peeling paint, things like that. Another drawback is that USDA does have an income limit, and it is for all people in the household. So if you have a married couple and you say, well, my wife makes $80,000, just don't count my income. I make $40,000 as the husband. You can't do that. In other words, there will be an income limit for all members of the household, whether you are using the income for qualifying or not. Does that make sense? Okay. Questions on USDA loans? Anybody ever done one? Okay, cool. All right. We'll move.
I did a couple years ago.
You did one, Matt?
Yep. Up in Cambridge.
On the real estate side?
Yep.
Yeah.
2-3.
Yeah, they're really not that bad. It's an area where if you as an agent live in a more rural area, you know, buyer come to me and say, I only have 3%. That's all I have. I cannot afford closing costs. And you know, you can't get closing costs covered for the most part in this market. Well, as of maybe 10 days ago, I know the market's shifting, but I said, well, here's an idea. How far out from the metro do you want to be? Because he mentioned he wanted to be in a quiet spot. And he said, well, I'd love to be somewhere south, you know, south of Hastings. I said, you know, a USDA product is available to you at 0% down. All you have to do is cover your closing costs. So certainly something to keep in the back of your mind if you have buyers that want more rural properties. Rural development could be an option. The rates on these are really quite good. All right, so those are the government loans, FHA, VA, USDA. Let's talk about conforming loans. So these are loans that conform to underwriting standards that are set by Fannie Mae and Freddie Mac. You'll sometimes see these called privately insured mortgages, and that's because they are requiring private mortgage insurance for borrowers that have less than 20% down. The data, about 3 in 4 properties bought in the United States, and Minnesota's data is a little bit smaller than that. I think 72% was the number. But you know, still, you're talking about 7 in 10 properties that are financed using conforming or conventional loans. So this is the sort of bread and butter when it comes to mortgage financing in the state and the country. I really hope that I didn't just duplicate that slide. Look at, you get 2 different versions. You get the pool version and you get the house version. All right, here we go. Advantages in conventional loans. Typically, you're looking at a 5% down payment, but if you have borrowers that qualify with less than 80% of the area median income, you can do 3% down, okay? What the heck is 80% of the area median income? If you've been in the Tuesday meetings, which I know you guys largely are, you hear me talk about $83,000. That's sort of the dividing line in many of the major metropolitan counties. So anything less than $83,000, you should be fine with a 3% down conventional loan, okay? That said, this is the antithesis of USDA. USDA is going to count every nickel and make sure that you are not over the income limit. These 3% down conventional loans will only take into account qualifying income. Let me give you an example. I've got some borrowers right now that the wife works part-time, the husband makes about $120,000 a year, but only $81,000 of that is his base salary. So if I take out bonuses and commission, and if I take out her income, we are just left with $81,000. And that makes them, as long as they qualify, which they do, that makes them eligible for a 3% down conventional loan. Now, it doesn't always work this way. Sometimes you're going to get people that have a $96,000 base. You can't cut that down, right? But you can take out extra income from a borrower's primary or secondary job or rental income or whatever. As long as you're not using it for qualifying, then they can squeeze under this AMI limit. Again, we're running that Borrow Smart program right now, which is a $1,200 credit. So I'll go back to that same example with that couple. Not only does it put them in a 3% down category, it makes them eligible for a $1,200 credit toward down payment and closing costs. So the creativity is important sometimes in getting you from 5% to 3% down on conventional loans. Does that make sense? Okay. We talked about private mortgage insurance. It is cheap for borrowers as long as they have a credit score above 680. 680 is sort of the dividing line between FHA and conventional. Anything below 680 is typically going to go FHA. Anything above 680 is typically going to go conventional, right? Because the down payment is sort of a wash, especially if they fall in that 3% down category. And people say, I want my PMI to go away. I want a conventional loan. That's important that I did not note in this actual slide. Conventional loans, the PMI will fall off once you reach a 20% equity position in the home. Removing PMI can be done one of two ways. Number one, you just wait until you get to that 20% equity position, which at 5% down, that's typically about 8.5 years. Okay. You can make accelerated payments to push that down more quickly, or the most common option is that you engage the servicer whom you're paying mortgage payments to and say, hey, look, my house is appreciated 15% in value. I want you to come out and take a look at it and remove my PMI. Okay. But again, if you were an FHA mortgage holder, if you owned a property using an FHA loan and you said, hey, I want you to come out and, I've got 30% equity in this house. I want you to come out and remove my PMI. They're going to say, I'm sorry, Mr. Homeowner or Miss Homeowner, like you are on an FHA loan. You have PMI forever. I have a note in here about whose scores are used. And this is really important in my opinion, because a lot of people are misdirected on this. Credit scores for mortgage loan applications are pulled from 3 credit bureaus: Equifax, Experian, and TransUnion. Okay, so that each of them will spit out a score. Okay, and then the lender will use the lower of the borrower's 2 credit scores. So if you have, let's say you apply with your spouse, okay, they're going to be 6 credit scores, 3 for one spouse and 3 for the other spouse. All right, they'll use the middle score of the lower of the 2 spouses. Okay, so let's say a husband has scores at 700, 710, and 720, and the wife has scores at 680, 690, and 700. The wife's middle score of 690 would be the score to use. Does that make sense to everybody? I know it's a terrible example because women always have better credit than men. So apologies for that.
So basically, you just can't use somebody just to show a higher income to debt ratio. They're also going to use that lower of the credit score.
Exactly. So it's say, well, I'm just going to put this I'm going to add this person as an occupying co-borrower. I'm going to add my spouse to the income, or I'm going to add somebody as a non-occupant co-borrower because they make a ton of money. Well, if they've got bad credit, you're stuck with using their credit score. All right, conventional loans, easier appraisal process, like we talked about. You are going to be eligible for appraisal waivers at 20% down, which means that if you plug in 20% down at a particular purchase price and Fannie Mae and Freddie Mac say, oh gosh, we recognize that property. We did a conventional refinance on that property in 2020. And it's only, we valued it at X then, and it's only 10% higher than X. Yeah, we're okay with a purchase price of $430, right? Or yeah, Freddie Mac says, gosh, that's in our database as having sold in 2019 at 380,000 and, 510,000, 20% down. We're cool with that. We don't need an appraiser to go out and look at that property. That is something you can do, but only at 20% down. Okay. No appraisal waivers on FHA, VA, or USDA loans, conventional only. Questions about appraisal waivers? I know they're a hot topic right now.
Yeah, for the appraisal waiver, does that come out of your down payment or do you have to pay that separately?
Say more. I'm trying to make sure I understand your question.
So like, let's say you're buying a $500,000 house, your down payment is 20%, 100,000, but you offer 520. But then the house appraises at 500. Do you pay the appraisal gap from the 100,000 you have for the down payment, or do you have to come up with another 20,000 to cover that appraisal gap?
Okay, I understand. The lender should put in what the purchase price is and see if an appraisal waiver is acceptable at that value. Okay, so let's use your example, $520,000 and then 20% down, right? Which is 104 grand. So that would leave you with a loan amount that is $416,000. My math is right. Okay. So you can finance that right up to 80%. If it fires with an appraisal waiver, you're fine at $520,000. Okay, an appraisal waiver will match the purchase price, right? So where you get stuck is if that you don't get an appraisal waiver at the purchase price, you need to do a traditional appraisal, and then the appraiser comes out and values it at 500. Then depending on how the purchase agreement is written, the buyer could be on the hook for that gap between appraised value and purchase price. Does that make sense?
Yeah, so the lender, if you do an application or an appraisal waiver, the lender might pay for the appraisal gap if you qualify or whatever, or it's in the agreement.
So the lender doesn't pay for anything, but the lender will use the appraisal waiver to ensure that the purchase price is correct. Okay, so what you need to do is don't think about 500 for a second. Just think about, hey, we're doing a loan on a $520,000 house, purchase price accepted, and we're doing a 20% down loan. The lender's going to plug in 520 purchase price at a $416,000 loan amount. That's 20% down, and then see if it's acceptable for an appraisal waiver. If an appraisal waiver comes through in that example, then the appraised value is $520,000. Boom, you're done. Okay. And then the borrower is only responsible for 20% of what the purchase price is, right? Which matches the appraised value.
Okay. Yeah, I think that makes sense.
If it doesn't, that's okay. I mean, we can talk about it a little bit more.
So
It's
we wouldn't run into ever needing to use an appraisal gap due to the fact that the submitted price is what Fannie or Freddie agree is the appraised value. So we wouldn't need to even negotiate on a gap in this circumstance.
And that brings up an important point, which is if you have conventional buyers who have 20% down, you should be checking for appraisal waivers with your lender partner when the purchase agreement is written, when the offer is written. Okay. Why is that? And I've hammered on this. So if you've heard me talk about this over the past 8 months, you're going to hear it again, right? The thought is that if you can guarantee the price to the seller through an appraisal waiver, then there is total strength in that offer. So let's use your example again. Hey, $500,000 listing price. We're going to go in at 520. Well, if you get an appraisal waiver, then you don't have to talk about a gap. You don't have to talk about renegotiation. You don't have to talk about anything, right? Because you're saying, hey, my buyer at 520, we got an appraisal waiver. So you have collateralized the price. You have fixed the price. You know that nothing is going to change that price from $520,000
Right.
unless you have an inspection and things like that. But by fixing that price, now the seller is saying, okay, I don't have to worry about an appraiser coming out here and saying the property's not worth what we agreed upon because there is no appraiser involved. So if you're writing 20% down conventional deals, absolutely work with a lender partner, and not everybody does it. Okay. But in our case, we will check for an appraisal waiver on every single property that the 20% down conventional buyers are offering on, because it can strengthen your offer and better your chances of getting it accepted.
Okay, but this only works if you're approved for more than the 520, right?
You mean debt to income wise?
No, like your loan, you're approved for 520, so you can use up to that, if that makes sense.
Correct, right. So I mean, that's a totally different metric where it's like, do you qualify at 520? That's a different story, right? Does your debt to income ratio meet conforming guidelines, right? Is your credit up to snuff? all of those sorts of things. You know, again, and that's a really interesting thought in that, you know, the mortgage underwriting process is based on income, credit, assets, and property. Okay. So, you know, income, it's pretty simple, right? In terms of pay stubs, W-2s, let's calculate what someone's income is. And then credit, which is going to be your score, obviously, but also any other debts that you have, car loans, student loans, credit cards, collections, etc. The third part being assets, you know, which you're going to use for the down payment, whether that be checking, savings, gift, stocks, 401k, 401k loan, IRA, things like that. And then the fourth one being property, right? So the appraisal waiver is really only applying to the property part of that underwriting process, right? The appraisal waiver is simply determining the collateral's valuation.
Right. Okay, yeah, that makes sense.
Cool. Any other questions on waivers or that four-pronged underwriting approach? Okay, conventional loans, really only one disadvantage, and that's, you know, you're going to qualify for a little bit less on a conventional loan. That debt to income ratio usually falls somewhere between 45 and 50%. Again, with FHA, you can go above 50%, sometimes above 55%, VA sometimes even higher. So you are a little bit more restricted with qualifying ratios on conventional loans. All right, let's talk about the third bucket. The third bucket, we got government. All right, I understand that, Colin. All right, and conventional, yeah, I get that. So what about non-conforming loans? Okay, and Kristen, this comes right back to your question about the conforming loan limit, right? So any loan that is above a certain threshold that is established county by county will fall into a non-conforming category. I'm going to get to those limits on this next slide. The advantage here is that it allows you to buy $1 million property, for example, and you are not saying, okay, well, I can only borrow the maximum that Fannie Mae and Freddie Mac allow me to, right? There are jumbo loans available for buyers in this price point. That is, you know, in the high six figures and low seven figures for purchase price. Typically, these loans are 20% down, and you are going to have tighter qualifying ratios and a more difficult underwrite. Why is that? Well, you got to understand that these banks, if they're doing an FHA, VA, or USDA loan, those are all insured by the government. So if the borrower defaults and stops making payments and forecloses, you know, it's HUD's problem. It's not US Bank's problem. Okay. Conforming loans really are the same way. Okay. The lenders are going to do conforming loans and package them up and sell them to Fannie Mae and Freddie Mac. And if the borrower defaults, it's not the lender's problem. Okay. But these loans have no home, pun intended, right? They are loans that US Bank or Wells Fargo or whoever's doing non-conforming, you know, us, you know, they do not get sold. Okay. They're not purchased. And so because you'll have these lenders keeping these $1 million loans, for example, on their books, they're going to make sure that they analyze every document that's involved in the transaction. Okay. So it can be a more difficult, more painstaking underwrite with jumbo loans. So we talked about loan limits. What does that mean? Loan limits represent the maximum borrower amount for a borrower. Nice. Maximum borrowing amount. Okay. So this is loan amount, not purchase price. All right. In the county metro area, Minneapolis, St. Paul, the conforming loan limit this year is $647,200,000. Okay. It went up 100 grand from last year. Right. So that means that if you have somebody that is looking at a property that is, you know, let's say $680,000, they can do that with a 5% down loan. Okay. Or even a 3%, but I mean, they'd have to really squeeze under that income limit that we talked about, you know, in qualifying with an $80,000 income on a $680,000 house might be difficult. Okay. But the reality is that anything up to about $680,000, they can do a 5% down conventional loan on. Okay. FHA limits, that is depending on the property type. And so is conventional, but I did not put that in there. So for example, you have people that are out there, and with Minneapolis's zoning change, this has been very hot in terms of ADUs, accessory dwelling units, duplexes, triplexes, fourplexes, things like that. The FHA limit for a single family, 420,000 and change. Okay, so a little bit lower than conventional. For a duplex, that limit will go up to 538. Triplex, 651. Fourplex, all the way up to $809,000 if you have a 4-unit property. So it might sound crazy, but if you are an owner occupant of a fourplex and say, hey, I want to buy this fourplex for 800 grand and I'm going to occupy this unit, you can buy an $800,000 property and put 3.5% down. FHA will allow you to do that. Okay. The loan limits typically change year over year. Usually that information is out the day after Halloween. And you're going to see that what Fannie Mae and Freddie Mac, and then HUD following suit, will say, okay, you know, what's a reasonable loan limit for this metro area, right? And with home prices appreciating, you will see that change year over year. Some areas in the country have super conforming loan limits. So if you look at Los Angeles, for example, you're going to see loan limits that are, you know, almost $1 million that borrowers can put a 5% down loan on. And that is the end for today's Mortgage 101. Wow, 45 minutes. I talked for a long time. Questions? I mean, that's just a brief overview of the 3 different buckets that that loans typically fall into. Anybody? Cool. Okay. Holly, I think we can post this again. Maybe we'll just continue to post this on the Facebook page, or if we can, we'll talk about where to put this slide deck or whatever, you know.
Perfect. This was awesome. Thank you so much for doing this.
You bet. Thank you all for, I know you're all busy, so thank you for jumping in, and I hope you learned something.
Cool. Thanks, Colin.
Thank you, guys.
Thank
Colin.
you.
Bye-bye.
Thanks, Colin. I'll make sure to get this recording over to you guys too, just so you have it as well. And if there's anything you guys need, let me know.
Cool. I mean, this, kind of what we're looking for. I mean, you know, it's good, right?
Yeah, absolutely.